So 80% of the mangroves in Burma have been destroyed. And Burma has a lot of area that is flood prone, right? So mangroves are just amazing miracles. They grow in salt water, right? Under ideal conditions, they can actually sequester up to 1 ton of CO2, permanently in the ground, while providing flood protection and all those other benefits that, there's more fish that people catch. So Arne's idea is essentially that he can plant 1 mangrove seedling for about $1, right? And that we can structure an investment in which this is actually then registered in an Ethereum registry, the Regis registry, so you could buy a certain number of trees and you would have the carbon rights to that tree. So the economic benefit of this 1 tree, 1 ton formula, that's under idealized circumstances. The realistic figure might be that we could only produce maybe 1/3 of that, but the economics still make sense. So, but I'll work with the simple numbers, right? So the value of that $1 investment that sequesters 1 ton of carbon is that global harm is reduced by $220, roughly. That's the social cost of carbon, according to Stanford. And then projects like this have co-benefits on average of $664 per ton, right? So you can see that $1 investment, in this case, it'll take 20 years to generate that ton, will have, close to $900 of benefits, right, in an idealized circumstance. Even if it's 1/3 of that, $1 goes to 300, still pretty good. So the question is how can investors, right? The world wins, right? It takes carbon out. The local community wins. It provides flood protection and increases fishery catch, and you can do other things like have bees there and so on. But how does an investor make money from that is the question, right? And in this particular case, what's nice is that there is a carbon market, right? And there's an institutional carbon market where about 12% of the carbon dioxide that is produced in the world by humans, there's a market for that already. The size of that market is $50 billion or something like that. So that's the regulated market. But there's another market that's interesting. It's the voluntary carbon market, where 0.3% of companies have decided voluntarily that, we will assess our carbon footprint and we will buy carbon credits and offset them. And what's interesting is if you look at who the 0.3% is, then you'll get it. It's all the leading firms, right? It is, Google, it is Microsoft, it's Goldman Sachs, it's Adidas, it's Puma, and so on. So if that 0.3% goes to 3%, we can see that this will be something quite extraordinary. And the amazing thing is that 0.3% will go to 3% at some point in time. There's never been a case of a company saying, we've decided to be carbon neutral, and then the next year say, actually that was a terrible waste of money. We're just going to go and pollute again. So it's an amazing thing because these companies simply look at the map. They're like, we could spend our corporate social responsibility dollar in terms of, making advertisements like ExxonMobil does, for example, about how wonderful they are, and then have, journalists actually criticize every single one of these things to say that actually you don't do these things. Or we could actually walk the walk, right, and support projects like Arne's, support another project that we're working on in Borneo, which is a wonderful project by the person who first came up with the accounting methodology that allows private capital to save forests, right? So it's an amazing market, and that market could expand quite dramatically, right? So if you look at if you look at the world as a risk manager, right? What I've learned is focus on exponentials and think in terms of scenarios, right? So what we do have is we've got an exponentially growing awareness that our ecosystem matters, and at the same time we're racing exponential escalation in climate change. And the second thing is looking at it in terms of scenarios. I talked to one former hedge fund manager who managed the money for Soros. He did the investments in mining companies, right? I thought this would be perfect for him, like to look at carbon credits as a as insurance to his very carbon-intensive industry. But he had the typical way of thinking of many people, which is, carbon markets, people have talked about that for a long time. They've collapsed and there'll never be a carbon price, right? To which my response is, maybe you're right, but maybe you're not. And there's a whole range of scenarios, right? So you have to think about, there's the chance that we don't do anything, that there's a chance that we have a low price for carbon, a moderate price for carbon, or a high price for carbon. And each of those has a probability. And then if you actually look at what those prices are, right, then it gets actually very interesting. The lowest social cost of carbon estimate of any government is the United States estimate of $38 per ton. ExxonMobil has a planning price of $80 per ton, right now. Sweden has implemented a price of about 111, and actually Switzerland has a national carbon credit system where on average in Switzerland in the voluntary carbon market, actually no, this might be the regulated carbon market, apparently the average price was up to 160 Swiss francs. And then you have Stanford's social cost of carbon at 220, and then you have risk managers like Bob Litterman, former head of risk at Goldman Sachs Asset Management, saying, it's a very simple picture here. We have a derailed train, he shows a picture of a derailed train, and saying that train went around a corner too fast. So the optimal response if you're a risk manager, if you're driving a car and you realize you're going too fast, around a corner, you don't just very gently touch the brake, you have to actually hit the brake pretty hard, right? And then you can let go, right? So essentially what he's recommending is that the optimal strategy for carbon pricing that most people think about is this curve that goes upwards. So the really bad scenarios happen in 50 years, 40 years, 30 years, and then you discount them, right? He proposes that that's actually, using this discount rate is actually quite foolish, and that the optimal risk response is the shape of the curve should look the opposite. It should be backwardated. You put a really high price first, and then you lower the price. So that would be scenarios up to $300 to $400 to $450 per ton. And interestingly, at the seminar, this was the ERM symposium in Chicago 2 years ago, where Bob Litterman spoke, and I spoke there as well. I spoke to someone from ConocoPhillips on what he thought was the most interesting scenario. He thought